Picture this. You wake up on a brisk morning, reach for your phone, and see headlines screaming about financial markets in turmoil. The value of your currency is slipping away as inflation surges, and governments worldwide are frantically trying to plug gaping holes in their budgets as debt mountains reach dizzying new heights. In that moment of uncertainty, where do you turn to protect your hard-earned savings? Do you trust the ancient gleam of gold, a metal worshipped and hoarded for millennia? Or do you take a leap of faith in the new frontier, Bitcoin, the digital phenomenon that's shaking the very foundations of global finance? This choice is no longer just a thought experiment for Wall Street insiders or tech-savvy millennials. It's a pivotal question at the heart of a debate that could reshape how trillions of dollars move across the globe in the coming years. Let's step back and understand why this dilemma is so urgent. For thousands of years, gold has been the anchor in every economic storm. The pharaohs of Egypt filled their tombs with gold, believing it would follow them into eternity. Emperors, kings, and conquerors from Rome to China measured their power by the gold in their vaults. When currencies collapsed, from the paper marks of Weimar Germany to the rubles of post-Soviet Russia, people clung to gold as their last refuge. In the Great Depression of the 1930s, when stock markets crashed and banks closed their doors, those with a few gold coins found they could still buy bread. During the inflationary crises of Latin America in the 1980s and the chaos of Zimbabwe in the 2000s, gold was the universal fallback, accepted everywhere, trusted by all. But now, in our hyper-connected digital-first world, a new asset is making waves. In the wake of the financial meltdown of 2008, an anonymous figure known only as Satoshi Nakamoto unleashed Bitcoin, a digital currency designed to be beyond the reach of any central bank or government. Unlike gold, which is dug from the earth, Bitcoin is conjured from pure mathematics, created by computers solving cryptographic puzzles, verified by a global network with no single point of failure. The total possible supply? Exactly 21 million coins, coded in from day one, no more, no less. Like gold, Bitcoin is pitched as a shield against inflation, a lifeboat when traditional currencies start to sink. But while gold's story is written in centuries of tradition, Bitcoin's tale is still unfolding, driven by technology, ideology, and a fervent belief in digital freedom. Zoom in on today's economy, and you'll see why this debate is so fierce. Political tension is at a fever pitch. In the United States, partisan rifts grow deeper by the day, with a contentious presidential election looming. Across the Atlantic, Europe faces an energy crunch, war at its doorstep, and a cost-of-living crisis. Emerging markets are rocked by volatile capital flows as interest rates seesaw from Washington to Tokyo. Central banks are battling a stubborn foe, inflation. In the United States, inflation is forecast to cool to 5% by June of next year. While this is a 3-month low, it still towers above the Federal Reserve's goal of 2%, keeping markets on edge. Meanwhile, government debt is ballooning at an unprecedented pace. The United States federal debt now stands at more than $34 trillion, an almost unimaginable figure, casting doubt on the long-term strength of the dollar and threatening to upend the global financial order. Given these storm clouds, it's no surprise that investors are desperately seeking alternatives. But which is the true safe haven, ancient gold or digital Bitcoin? Let's peel back the layers and examine what's really happening beneath the surface. On the face of it, Bitcoin's popularity among everyday investors seems to be fading. According to Google Trends, global interest in Bitcoin has fallen to its lowest level since last October. The wild fever of past bull runs has cooled, replaced by a sense of cautious optimism, or even skepticism. But dig deeper, and you'll find a very different story. Behind the scenes, long-term Bitcoin holders, those who have held onto their coins through boom and bust, now control almost 3/4 of all Bitcoin in circulation. That's a historic high. This suggests a powerful vote of confidence from the most committed investors, who are betting that Bitcoin's best days are ahead, not behind. Meanwhile, the world of financial derivatives, complex contracts that let traders bet on Bitcoin's future price without owning the actual coins, has exploded in size. Open interest in Bitcoin derivatives recently surged past $15 billion. This means more money than ever is being wagered on Bitcoin's next big move, often amplified by leverage, borrowed funds that can turn small bets into massive gains or catastrophic losses. It's a double-edged sword. Leverage can supercharge profits, But when the tide turns, it can also trigger brutal sell-offs and margin calls, sending prices crashing in a matter of hours. Gold, for all its timeless allure, is facing its own challenges. Exchange-traded funds, or ETFs, that track the price of gold are seeing outflows. Many investors are quietly trimming their gold exposure, even as central banks keep buying at a breakneck pace. HSBC, a banking giant with roots stretching back over a century, just bumped its gold price forecast for next year to more than $3,200 per ounce. Their reasoning? Relentless demand from central banks, coupled with rising geopolitical risks and growing doubts about the dollar's dominance. Yet, technical analysts warn that gold is struggling to break past key resistance levels. Without a major catalyst, a global shock, a sudden plunge in the dollar, or a severe stock market crash, gold might struggle to break free from its current trading range. On Wall Street, institutional investors are making bold moves. Almost 1/4 of all United States Bitcoin ETF assets are now in the hands of major institutions, pension funds, hedge funds, and endowments. This is a sea change from just a few years ago, when Bitcoin was dismissed as a toy for tech geeks and cyberpunks. According to Glassnode, a leading blockchain analytics firm, this institutional influx could send Bitcoin soaring to new heights if the trend continues. But there's a catch. If too much money is chasing too few coins, and if leveraged bets start to unwind, it could set the stage for a brutal correction. Expert opinions on this gold versus Bitcoin showdown are sharply divided. Nikolaos Panagurtsoglou, a respected analyst at JP Morgan, believes that Bitcoin could outshine gold in the second half of next year, especially if money keeps flowing into Bitcoin ETFs and regulators finally provide clear, supportive rules. He points to the shrinking correlation between Bitcoin and traditional indices like the S&P 500 as a sign that Bitcoin may be carving out its own identity as a safe haven. On the flip side, Mike McGlone at Bloomberg Intelligence is waving a red flag. He notes that the Bitcoin-to-gold ratio, a key metric comparing the relative values of both assets, is flashing warning signs. In his view, Bitcoin may be overvalued compared to gold, especially given the flood of leveraged bets. If the broader market stumbles, he warns, Bitcoin could suffer a steep correction, tumbling back toward its 200-week moving average and erasing months of gains. And let's not forget the wild cards, the unpredictable events that can send markets into a tailspin. Regulatory crackdowns, new technological breakthroughs, or sudden geopolitical shocks can change the game overnight. Imagine a major government banning Bitcoin trading, or a massive cyber attack on a major exchange, or even a surprise announcement from a central bank about digital currencies. Any one of these could send shockwaves through both markets, upending even the most careful predictions. To truly understand the stakes, let's walk through a possible future scenario. Fast forward to the middle of 2025. The global financial system is jittery. Inflation in the United States has cooled to 5%, but trust in traditional assets is fragile, battered by soaring national debt and repeated political gridlock. Central banks and the world's biggest investment funds are at a crossroads. Do they double down on gold, the ultimate symbol of safety, or embrace the bold promise of Bitcoin? In this scenario, a shock could erupt almost anywhere. Political chaos in Washington, a tech meltdown on Wall Street, or a regulatory bombshell from Brussels or Beijing. If central banks keep buying gold at record speed, and if geopolitical tensions remain high, gold could leap past $3,500 per ounce, a level never seen before. Meanwhile, if institutional investors keep pouring capital into Bitcoin ETFs, and if long-term holders refuse to sell, Bitcoin's price could skyrocket. Some analysts quietly talk about targets as high as $200,000 per coin by the end of the year. Of course, these projections are speculative. No one can predict with certainty where prices will go. But the mere fact that such numbers are being discussed highlights how volatile and unpredictable these markets can be. On the other hand, the faith of long-term Bitcoin holders is stronger than ever. Nearly 73% of all Bitcoin is now held by wallets that haven't sold in over 6 months. This cohort, sometimes called the diamond hands, has a history of driving powerful rallies. In previous cycles, when supply dried up and demand surged, Bitcoin posted multi-year bull runs. Compare this to earlier periods. In 2017, only about half of Bitcoin was held by long-term believers. Their growing influence is forcing analysts to rethink how they model Bitcoin's price dynamics and risk profile. But retail interest is waning. Google Trends data shows that searches for Bitcoin are at their lowest levels in many months. The wild, speculative mania of earlier years has faded, replaced by a cautious, almost clinical interest. This could mean that the market is maturing, with price moves now driven more by institutions than by hype. It could also signal vulnerability. If institutional enthusiasm dries up, or if governments impose tough new restrictions on crypto trading and custody, Bitcoin's momentum could grind to a halt. Already, countries like China and India have moved aggressively to clamp down on cryptocurrency activity, while regulators in the United States remain locked in debate over how to police the industry. The interplay of these forces, deep conviction among holders, massive institutional flows, regulatory intrigue, and shifting public mood, creates a market that is equal parts opportunity and peril. If Bitcoin continues to decouple from traditional markets, if it becomes truly uncorrelated with stocks and bonds, it could finally earn its reputation as a digital safe haven. But history warns that, in a global crisis, even the most promising assets can stumble. In a severe recession or systemic shock, correlations can soar as panic selling engulfs every corner of the financial world. The lesson? No asset is completely immune when the storm hits. Let's put this all in historical context. Gold's resilience is legendary. It has weathered every crisis thrown at it, from the collapse of empires to world wars, from hyperinflation to financial panic. In 1971, President Richard Nixon shocked the world by ending the dollar's direct link to gold. Many predicted gold's downfall. Instead, gold prices soared as investors scrambled for a reliable store of value. In the late 1970s, with inflation raging and growth stalling, gold jumped from $35 an ounce to over $800, more than 20 times its value in less than a decade. During the global financial crisis of 2008, gold again rallied as investors abandoned stocks and sought shelter in something timeless and tangible. Bitcoin, by contrast, is a newcomer. Its 15-year journey has been a roller coaster. After peaking near $20,000 in late 2017, Bitcoin crashed to just above $3,000 the following year. Critics called it a failed experiment, but Bitcoin came roaring back, reaching new highs as institutional players entered the market. Financial giants like BlackRock and Fidelity now manage Bitcoin ETFs, while even some sovereign wealth funds are adding crypto to their portfolios. The recent rally has been driven by both faith in Bitcoin's long-term scarcity and by the growing acceptance of blockchain technology as a disruptive force. Meanwhile, central banks are quietly stockpiling gold at the fastest pace since the Cold War. China, Russia, Turkey, and India have all boosted their gold reserves, seeking to reduce their dependence on the dollar and insulate themselves from Western sanctions or geopolitical shocks. According to the World Gold Council, central banks purchased more than 1,000 metric tons of gold in the past year alone. This relentless demand is one factor behind HSBC's decision to raise its gold price forecast. For these nations, gold is not just a hedge against inflation, but a strategic asset, a way to protect sovereignty in an unpredictable world. But the financial landscape is being redrawn by technology. Blockchain, the foundation of Bitcoin and other cryptocurrencies, promises a future where money is programmable, borderless, and immune to censorship. Some countries are experimenting with central bank digital currencies, while El Salvador has famously made Bitcoin legal tender. If more nations follow suit, or if blockchain-based finance gains mass adoption, the very nature of money and what we consider a safe haven could be transformed. Imagine a world where you move your savings across borders instantly, without banks or bureaucracy. That's the promise and the risk of this new era. If you lean toward gold, you're embracing centuries of tradition. Gold is slow to move but incredibly robust. It doesn't rely on electricity, internet access, or passwords. In times of war, famine, or disaster, a gold coin or bar has always found willing hands. But don't expect explosive gains unless the world truly comes undone. Gold's strength is in its stability, not its speed. If you're drawn to Bitcoin, you're betting on the future. With a strictly limited supply, growing institutional endorsement, and a generation raised on digital technology, Bitcoin could be on the verge of another dramatic run. But beware, the road is treacherous. Brutal corrections, regulatory shocks, and technical failures are always lurking. Diversification is your best defense. Never stake your future on a single asset, no matter how compelling its story. In this new financial frontier, discipline and continuous education are vital. Keep up with global economic trends, evolving regulations, and technological innovations. Resist the siren song of hype and be wary of leverage. Many fortunes have been lost by those who borrowed heavily in good times, only to see their gains evaporate in a downturn. No single asset, neither gold nor Bitcoin, offers total security. Each reflects our deepest hopes and fears about what the future may bring. As Nikolaos Panagurtsoglou of JP Morgan notes, Bitcoin could yet eclipse gold if regulatory clarity and institutional flows persist, but only the tests of time and crisis will reveal which asset truly endures. Here's a crucial but often overlooked fact. As of June of 2025, the share of Bitcoin held by long-term investors is at an all-time high. Never before have so many coins been in the hands of those unwilling to sell, even as prices whipsaw. This silent show of confidence is forcing analysts to rethink risk models, since historic supply squeezes have often set the stage for multi-year rallies. In the end, can Bitcoin dethrone gold as the world's ultimate safe haven? The answer for now is complex. Gold's legendary track record, central bank demand, and physical presence give it formidable staying power. But Bitcoin's digital scarcity, technological backbone, and growing independence from traditional assets are opening up entirely new possibilities for investors and nations alike. The duel between these giants is only beginning, and its outcome will be shaped by a tangled web of economic, political, and technological forces that no one can fully predict. So, as you craft your own safe haven strategy for whatever storms may lie ahead, ask yourself, are you drawn to the enduring comfort of gold or the bold promise of Bitcoin? Will you trust in the solidity of the past or bet on the innovation of the future? There is no single right